let's connect then with Hiren Ved, CEO and CIO Alchemy Capital Management, who now joins in on the show. Hiren, the question is, with this gush of liquidity, the markets have definitely been buoyant, but do you think that we are likely to see this continued momentum into the new year, or are we likely to see, some sort of a major blip kicking in and a correction that's long overdue?
Yeah, I think, hi, good morning to everybody. And, I think, we are very, very constructive on the markets from a medium to long-term perspective. However, in the near term, it is quite possible that the markets could correct. But I think that the correction will be very shallow and swift and fast. And that's because I think that there is a large amount of domestic liquidity which is sitting on the sidelines, which has been consistently selling through this rally ever since Nifty has crossed 10.5, 11,000. And if you look at the data of outflows from mutual funds, you will see that they've at least sold, $10 billion worth of stock over the last 5 months, and that liquidity is either lying with them or with the end investors. And, on the first sign of a correction, I do expect this money to start flowing back again. But I think more than the debate on liquidity, which usually tends to hog the limelight when it comes to this rally, I think what most people are tending to forget is that while the first leg of this rally was definitely led by was led by liquidity. But I think ever since we've seen the Q2 numbers and now the early part of the Q3 earnings numbers, I think that what will drive the market over the medium to long term is earnings growth. And I think earnings are going to surprise people on the upside, just like they did in Q2. I wouldn't be surprised if you will start seeing earnings upgrade once the Q3 season is over. So I think there are more legs to just liquidity to essentially sustain this market.
Morning, Hiren. Nikunj also joining in. Hiren, what are the chances that in 2021, economy does well and markets do precious little? And the reason perhaps why I'm asking you this question is because markets have already run up in anticipation of an economic recovery. So even if markets have gone up because of a fundamental factor, the anticipatory move is already over.
So Nikunj, it's quite possible that the headline index, right, which is the Nifty and the Sensex, may give incrementally, may probably give not that great a return because all of the return has been upfronted. As you rightly mentioned, that the markets are very smart. They tend to discount the future well in advance. But I think where the opportunity will lie over the next 12 to 24 months is in the broader markets, right? And we did a study of the last 5 significant corrections in the Nifty, which were greater than 15% ever since the year 2000. And what we found was that even after taking the first 6 to 9 months of recovery in the Nifty, over the next 15 months, on an average across these 5 corrections, the Nifty was up somewhere between 9 to 10%. But the real interesting thing is that the mid cap index was on an average up 30-35%, and the small cap index was up 45 to 50%. So I think the action post the very strong recovery in the headline index, in my opinion, is likely to shift to the broader markets. And I think that's where incremental returns are going to be made.
Let's talk about pockets where you think there is scope for earnings surprise. Uh, Outside the obvious themes like IT, pharma, cyclicals, industrials, how are you navigating your portfolio to generate superior returns?
So I think Nikunj, I think the surprises will continue, in my opinion, to come from in pharma, followed by consumer discretionary, which got hurt, during the pandemic, but I think which should rebound in 21-22, and also in cyclicals, right? I think metals are already off to a great start. That's not an area that we usually participate. But I think if you look at other cyclicals like autos, etc., right? So the likes of Tata Motors, Maruti, ancillaries, etc. I think there is money to be made there selectively. I think in capital goods, I think in real estate, and housing finance companies, there could be a significant upside from where we are today because they're just starting a new cycle now. So, I think, it's very difficult to talk sectors when you talk mid and small caps or the broader market. So you have to be very much bottom up. But, I think that even though IT has had a good run up, I still feel that the sector can give very strong returns over the next 12 to 24 months. This is just, and I think every large company, even though it is very well researched and very well followed, the fact that large companies are able to beat the consensus by a handsome margin tells me that the sell side is way behind the curve in picking up in picking up the fact that tech is on to a very strong structural growth story. Even in pharma, there could be upsides which are not factored in because typically, you don't. It's very difficult for analysts to take in all the potential upsides that could be there in your product pipeline, and therefore there could be potential surprises that could come in. So I think these two sectors will definitely do well. I think financials have to play some catch up because they are still underperforming the Nifty. But once that catch up is done, thereafter, I don't see the financials leading this market. I think they will be at best market performers. But I think consumer discretionary and cyclical sectors and stocks from those sectors could do phenomenally well.
When you say tech, are you looking outside the comfort of the obvious 4-5 names?
In tech, I think I think in tech, we have for the longest time we've been very bullish on Tata Elxsi and LTTS. Both these ERD companies have done. We think will do very well. Tata Elxsi has also already come out with its Q3 numbers. I think they've done industry-leading top-line growth and industry-leading margins. I think LTTS results are awaited, but I think they should also show in a very, very strong showing. And after a long time, within the mid-cap IT pack, I think the stocks that we really like are LTI, LTTS, and Tata Elxsi. And I think that's where we've put our bets on. And we think that there is still significant upside even after the recent run-up if one was to look at the next 12 to 24 months.
Hiren, what's your view on the entire divestment drive and the kind of intent that seems to be picking up there, deadlines, a lot of action across those PSU names? What are you making of that?
So, Abha, I think, privatization stroke divestment could be a big game changer this year from a macro perspective, right? But I think we've seen too many fits and starts in the past. And what the market would be looking at is that amongst the existing pipeline of divestment stroke privatization, BPCL, Container Corporation, Shipping Corporation, Air India, even if we are able to get two of these four or five that are being planned outside, through the door, I think there will be, then I think that the entire PSU pack can get re-rated, because I think the proof of the pudding is in actually getting this executed, right? So we constantly live in this hope that it will get done. It will get done. We've been talking about it for a long period of time. But I think if we are able to get at least two of these executed, I think that could be a trigger for a more sustained, broader rally for value unlocking in the PSU space. And I think the problem there is that every time stocks rise, there is more offering and more supply that is given. But having said that, I think we need to see some real action on the ground. And I think once that happens, and I think the intent of the government is there to get it through the door this time. I think once that happens, I think there is a significant opportunity to make money in PSUs.
Coming through in PSUs. I think one pocket we didn't touch upon in your overall strategy, Hiren, is commodities. What are you making of the kind of run that we're seeing there? Also, of course, keeping an eye on developments in global markets and how we're reacting to that. But what's your sense?
So, I think, Abha, that we are witnessing a very strong commodity rally. There has been an underinvestment in the commodity space for several years. And I think that with all the major economies of the world, putting in large amounts of stimulus and spending focus on infrastructure around the globe, I think that commodities should enter a very good era over the next couple of years. Having said that, I think in the near term, we've seen a very strong rally. There could be some pause and consolidation, but I think that the rally in metals and cyclicals has definitely more legs left to it, and I think it's a long-term structural theme. And as long as the dollar remains under pressure, and the central banks continue to keep monetary policy loose, China has recovered very strongly. The economy has also been relatively strong, and I think therefore, and I think every country has put some sort of import barriers. There is some sort of focus on inward spending, more like the Atmanirbhar Bharat that we have in India, and I think that is likely to amp up the metal story globally. So I think we are onto something structurally great there.
Okay, so sounding positive when it comes to the commodities. Hiren, any near-term risks as you foresee it? I think this time in terms of domestic factors, there's not much expected in the near term. Budget seems to be you're quite priced in. I don't think any big surprises are expected, at least for the moment. It's more about the fund flows and whether or not there's any perceived risk or threat in the near term coming in on the back of that. What would you sort of factor in, especially if we're looking at broader markets? Because for retail investors, they're always the first to get burnt should we see any kind of correction.
So I think from a macro perspective, I think the biggest risk that I see is if there is a disorderly rise or a very quick rise in inflation. Oil prices have started to move up. I think up to $75 we would be okay, like every time in the past. But I think if oil goes beyond $75 and stays there for a long time, I think that could stoke inflation, and then RBI, which has, which has kept monetary policy relatively very accommodative, may have to change its stance. So I think that the nascent recovery that we are seeing in the real estate sector, with interest rates being so low and these lower rates and better liquidity can support growth in the near term as we recover from the pandemic. I think the only thing that we need to be careful about is a sudden spike in inflation, or if oil prices were to go up dramatically in a very short period of time. But I think other than that, broadly, I think we are fine. On your point about retail investors getting into the broader markets, I think, there has been a trend over the last couple of months, and obviously retail investors have done exceedingly well, having bought during the lows of the markets last year, and many of them are sitting on pretty good gains. But I think if they think that they can make 30, 40, 50, 80, 100% returns every few months, I think that is not likely to last. It never lasts. There is a phase in the market where momentum is very strong and you can invest on your own and make money. But I think that if money making was so easy, then I think nobody would actually do anything else. So I think people have just to be careful not to get carried away by the momentum. Stick to good quality companies, because usually what happens is when the broad markets tend to do well, the good, the bad, and the ugly, everything moves up. The tide pulls up all boats, and when the tide goes down, then things become very, very difficult. So I think we should have reasonable expectations of returns. But having said that, I think we continue to be very, very bullish on the broad markets over the next 24 to 36 months.
Yeah. Hiren, wanted to get in your take as to how you've looked at the IPO landscape. What a year 2020 has been. Root Mobile, Happiest Mind, Masgao Dogs, Burger King, Mrs. Bector's. How have you looked at some of these primary listings, and what is it that you'd keep in mind while investing in companies that just list?
So I think what happens is that in the early stages of a bull market like the one that we've seen in the second half of 2020, usually IPOs get a very, very strong response because there are fewer IPOs that are there, and people who have not been able to catch the rally in the secondary markets tend to participate very vigorously in the primary markets. And with liquidity being abundant, and I think last year, with the lockdown, people had a lot of time. People are sitting at home and trading and investing. But I think what happens is that soon, the laws of physics catch up. I think as entrepreneurs understand that the markets are, a lot of the IPOs are doing very well, they start pricing their IPOs, higher and higher. And then these extraordinary returns that you make in the first round of IPOs, typically towards, as that trend matures, it tends to peter out. So I think it's very difficult to make a generalized statement on how one should look at IPOs, but I think you should look at each company on its merits. It really depends on A, the quality of the company, and B, the valuation at which the stock has been offered. So I think this frenzy that we've seen, I think that some of these IPOs, were very reasonably priced and, reasonably good quality. And I think quality and price, these are the two things that you need to see going forward from here. I think the IPO pipeline will continue to be very robust in 2021, because every time there is a great market rally, there is always a huge line of issuances of paper, which is waiting to hit the markets. So I think we will see a very active IPO market, next year. And I think that investors should look at each one on their own merit before investing in the IPOs.
Okay. Well, Hiren, have a great year ahead and thank you for joining us.